the break-even point, claiming early versus full retirement age versus all the way till 70, is usually right there around 79 to 81. That's where all the lines sort of converge. Well, average life expectancy is much longer than that these days.
Peter, so good to see you. Welcome back, everyone. A really popular topic today. We are talking about claiming Social Security at 62, what you're really giving up. So starting benefits early, of course, sounds appealing, but the trade-offs can be bigger than people expect, especially if you're a high earner. So Peter, a lot of people think they can claim Social Security early and invest the checks. I've heard that a lot. Why doesn't that strategy work as well as it sounds on paper?
Well, we need an income. So under the premise of that thought, we would be working at the same time to provide the income that we need to live off of, as well as, in addition, collecting Social Security, thinking that we would invest those checks. But the reality is that that does not work as effectively as a lot of people think, for numerous reasons. Number one, the penalty for claiming early and working, which I'm sure we'll get into some details on that. Number two is that you're locking in a lifetime of lower benefits. And one day you will stop working and you'll need to replace the income. Well, if you've made the decision to claim and collect Social Security early when you didn't really need the income, if it's a necessity, that's one thing. But if you're capable, able-bodied, and still working and didn't really need the income, well, now you've locked in a lifetime of lower income, and as a result, we'll have to draw more from your savings and investments. And over the course of a life expectancy, on average, we're going to more than eat up the additional income that we would have received from Social Security during those years. You're giving up more tax-free income because only 85% of your Social Security is taxable. So 15% of it is tax-free. If you lock in a lower benefit, that means that less of your income is tax-free. Also, the same cost of living adjustment on a lower dollar amount is less dollars. So as the years go by and we get these cost of living adjustments that are supposed to account for inflation, your benefit will receive less of a pay raise for you. So numerous reasons why you probably should not rush out and claim Social Security early if it is not a necessity.
Right, because the longer you delay, at least you get a guaranteed increase as well.
Yeah.
I can't do that with the market.
No, and you're right. You cannot do that with the stock market. Rather unpredictable what the increase is going to be there. But with Social Security, it is guaranteed. And you reduce your benefit by about 30% if you claim early. And then every year you wait past full retirement age, it's an 8% guaranteed increase in your Social Security benefit amount. So yeah, you cannot guarantee that with the stock market, Erin.
Okay, so you touched on the earnings test. Let's dive deeper into that. Walk us through the earnings test. How does the $1 for every 2 rule affect someone who's still working while claiming Social Security?
Well, again, if you claim and collect early, not out of necessity, meaning you are working and earning an income at the same time, but choose to go out and claim your Social Security before full retirement age, for every $2 that you earn over the earnings limit amount, and this year that is $24,480. For every $2 you earn above that, they take back $1 of your Social Security as a penalty for double dipping, essentially, in the government's eyes. Now, that stops when you do turn full retirement age, but in the year that you turn full retirement age, there might be some time before that, and you still have an earnings test the year that you turn your full retirement age, which means if you've got an early birthday in the year, maybe not a big deal if it's, in the first half of January, but if it's later in the year, certainly the potential for earning more even in the year that you turn your full retirement age. So we've got to be careful about that. And sometimes it makes sense. I've even seen cases where we wait until the next full calendar year before claiming just to avoid this penalty.
Right. Okay. So you were talking about kind of percentages and what you give up a second ago. What is the real cost of claiming at 62 versus waiting until full retirement age, or of course, even 70 if you're able?
Well, it is a reduced benefit. You reduce your benefit by about 30% when you go and claim at 62. Now, every year that ticks by, the decrease is a little less impactful. But again, you're locking in a lifetime of lower benefits by making this decision. And that's your personal benefit. That's only you. You made that decision. Well, what if we take Social Security at face value for what they've been telling us for a couple decades here, and the system-wide has to also reduce benefits in 2033, like they say, and will only pay out about 77 or 75 cents on the dollar. Well, now we are reducing an already reduced benefit. And so this really could have big impacts, not only on you individually because you made that decision, but doubling down if the system has to subsequently reduce benefits as well. But I mean, there's numerous reasons here. Again, part of Social Security is tax-free. Wouldn't we want more tax-free income? The break-even point, claiming early versus full retirement age versus all the way till 70, is usually right there around 79 to 81. That's where all the lines sort of converge. Well, average life expectancy is much longer than that these days. And so every year that you pass that point of convergence, it's more profitable to have waited and delayed on your Social Security. Now, I'm not necessarily saying everybody should wait till 70. In fact, that's not the case. Not everyone should wait till 70. Not everyone can.
Right.
I think that Social Security is an effective tool that we should use, and used effectively, it would be to protect your personal wealth and personal assets as best as possible. Keep your money going as long as you would need it to.
Right. One of the reasons I always enjoy speaking with you, Peter, is because you're always thinking about the whole family, right? Also legacy, but specifically with family. And for those who can wait until 70, can you explain how claiming early affects your spouse, particularly when it comes to survivor benefits?
Sure. Well, all these pieces fit together, right? We're making decisions at 62, 65, 67, 70 that ultimately impact us for life all the way through our 80s and into our 90s, and not even just through our lives. It echoes through the lives of our spouse and our children and our beneficiaries. So these are big decisions that, again, play into that lasting legacy that you will have. The legacy that you create for your spouse can be impacted pretty significantly by your decision on Social Security. Between two people, a married couple, you receive 2 Social Security checks. But if one person out of that couple passes away, the survivor only gets 1 Social Security check. One person, 1 check. They do bump up to the higher amount from between the 2 spouses, but they would lose as little as 1/3 to as much as 1/2 of their Social Security income. And what is known as the widow's penalty, simultaneous to losing that income, all of the thresholds for our tax brackets also adjust to single head of household, meaning the bracket level thresholds move down, meaning that surviving spouse actually probably bumps up, paying higher taxes. And your IRMA levels for your healthcare, your Medicare premiums also adjust to single. And so that surviving spouse also might end up paying more in Medicare premiums. So there's numerous reasons why you need to think through this decision. And again, all of these pieces are interconnected. And that's why we try to bring them all together when we put together that optimized retirement plan for our clients at Richon Planning.
Right. And again, talking it through, clearly this is a puzzle, all different size pieces, and it's going to be different for everyone how it comes together. So Peter, if somebody would like to talk through when they should claim Social Security and how it fits into their retirement income plan, what's the best way to reach you?
Well, as you said, Erin, a wildly popular topic because it applies to almost everyone. Everyone is going to go through this question, but not everyone puts some time into understanding this, right? We've worked for 30, 35 years to build up these benefits. it's worth 30, 35 minutes to really understand how you could be impacted by the decision that you're making and educate yourselves on it. And that's why it is part of the plan that we put together. And if you would like to get that optimized retirement plan, or even just look at your Social Security, we got some great calculators that will help you arrive at a good conclusion on that and begin to incorporate the rest of your financial picture and your goals. So if you would like to take advantage of that, no cost, no obligation. It's a courtesy service that we offer at Richon Planning to do the Social Security optimizer and put together that optimized retirement plan. Give me a call, 919-300-5886, 919-300-5886. You can also go online, richonplanning.com. It looks like Rich on Planning, my last name, richonplanning.com. You can email me, peter@richonplanning.com. You can also text your name, by the way, to that number. If you want to just get in touch with a text your name to 919-300-5886. Important topic though, Erin.
Absolutely. Peter, thank you so much for your time today. I really appreciate it.
Always good seeing you. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. You know, one of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Peter Richon and Richon Planning are not affiliated with nor endorsed by the Social Security Administration or any other government agency.